What is up, everyone? Dalton Grados with Grados Capital here for another weekly newsletter looking at the week ahead for August 12th. First, I want to just briefly address, I know in my past few videos here on my channel, sometimes there is an audio issue where it's like a doubling effect, and sometimes it's crystal clear like it is now. So moving forward, it will be crystal clear. I discovered there was basically a processing issue in the recording software that would happen intermittently. So sometimes it would be fine, sometimes it would produce that doubling effect. So here today and moving forward, a little bit of extra work for me, but I'm basically recording the audio on a separate device and adding it back into the video after the fact, which should be always perfect. So let's get into these markets because last Monday, if you remember, and hopefully you're subscribed to my newsletter, by the way. So this week's newsletter is a video you're watching here, but last week's newsletter was written. Sometimes I'll do that. Just kind of, I guess, depends. I don't really have a schedule, to be honest with you. I think it just depends on what I'm feeling like doing. But and then if it's a video, I will email it to your inbox as well for free, totally free newsletter, link in the description. But that way you never miss a week, so you can stay updated. So last week, to review, we woke up Monday morning to an extreme, harsh sell-off in the market. So I want to go over that. I want to go over what was happening, and I want to reference last week's newsletter because we said, markets overnight bled hard. Japanese markets are tanking. VIX spiked to over 50, which is huge. Markets are definitely reacting hard and lots of volatility. I also mentioned we've had high VIX and lots of fear in the markets. That said, don't assume it's going to tank all day or week. We've already had a lot of shock in the overnight session. And for today, Monday, and the rest of this week, this is last week, we could balance out and recover from the shock. It could tank, but keep in mind, balance and recovery could happen too. I emphasize that because in these types of scenarios, amateurs get excited and want to bet the farm on shorts. Oftentimes, they've already missed the move. And that's what happened. Last week, we rebounded. So again, I'm not a genius. I am a licensed professional. I do this stuff for a living, but I've just, more so than all of that, it's just years of experience of being in the markets. And I'm certainly not as experienced as many other people out there, but really closely following the markets for about 5 years now, through lots of volatility and volatile times through COVID and all these things. I've just experienced this behavior time and time again, where, last week, if you were waking up Monday morning thinking the market was going to tank, you probably already missed it. And sure enough, we rebounded. So wanted to point that out and wanted to also quickly explain sort of what was the deal with this big market crash that we woke up to on Monday morning last week and then rebounded from. So in short, basically, you have the Japanese markets were what really tanked, and our markets kind of reacted to it as well, just because markets around the world, it had like the worst day since Black Monday, the Japanese market, or equivalent to our Black Monday in 1987, they had over in Japan. Now, the Japanese markets are very different than ours, and so let me explain just briefly what happened. So basically, like I said, they're different from us. Their interest rates have been low, while our interest rates over in the United States and in the Western world in general have been relatively high. So basically, in Japan, the interest rates were very low to where you could borrow money, borrow Japanese currency at a very low interest rate, almost free money. Think back to, say, COVID for our time, where money was basically free if you were borrowing money. You could borrow money over there and then use that money to buy U.S. stocks. The Japanese government, or Fed rather, not their government, but they basically decided to raise those interest rates. So now that trade was unraveling, and it shocked the markets. People that were buying or borrowing interest-free, buying our markets, could no longer do that, and that was not really a profitable trade anymore. That unraveled, and so I've brought us here into the Thinkorswim charts to show you many charts that we don't get on the TradingView charts, meaning mainly the VIX. So we see we had a huge spike up here, up to 65 last Sunday to Monday. And since then, we have come down. The VIX, by the way, volatility index, represents fear in the markets. And so this is a main thing that I look at when I'm thinking about, what's the deal here? Are the markets really gonna, is it gonna be bloody, or is it an overreaction? Is it gonna correct itself? And based off of this, I can see that the VIX, quickly spiked and has really mean reverted to now being in the 20s. It would be interesting to see if we, this coming week, break below the 20s and settle in here into our previous range that we've held for most of the year. So that's one thing I'm looking at. That's one thing I think you should be looking at is, really like this 20 level in the VIX. Because this is essentially a gauge of where fear is entering the market. We had a big spike. We're reverting back. Seems like we're cooling down. Seems like that the market is probably just going to rebound. We had a big reaction here, and we're going to be fine. Again, I would watch this 20 level to see if we rebound or if we enter back into sort of this range. If we enter back sort of into this range, that would signal to me that investors, at least in the U.S. markets, have pretty much shrugged everything off, and we're back to normal. Okay, so that's one thing I would be looking at. Now, there are other factors besides that Japanese trade. We did get some data that would suggest last week we got some data that would suggest that the labor market is weakening, which we have been monitoring. I've mentioned in previous newsletters that we're monitoring cracks in the labor market. Again, not necessarily bad news. Sometimes bad news is good news. We've talked about this before. If the labor market is going to is getting worse, it would signal that the Fed needs to step in sooner with rate cuts, which is bullish for the market. So sometimes bad news is good news. But all the headlines going around, and by the way, and let me I don't want to make this video too long, but I also want to hit these points because I see so much of this. The media loves weeks like last week where the market dropped harshly because they love to spread that fear. And the media is in the business of getting attention. They're not in the business of trading and making money in the markets. They're in the business of getting your eyeballs. So they love to get those juicy, fear-mongering headlines. And that's what they were able to do with last week's market action. And so I just want to address that because you see all these articles going around. We had some labor data last week show that maybe the labor market is weakening. And so all the headlines were like, fear in markets because labor market weakening. Again, sometimes bad news is good news. We already made that point. But then we also had, I believe on Thursday, unemployment claims came in better than expected. So meaning there was less claims for unemployment. They expected 241. We got 233. So that was a signal showing maybe the labor market's not that bad. So you had one bad thing, you had one good thing. It's kind of all whatever, balancing out. So let me go ahead and look at just events for this week to kind of keep along with our newsletter. We have the normal economic data that we've been watching. If you've been paying attention to newsletters every week, PPI. We have Wednesday coming up this coming week. I'm talking about this next week now for August 12th. Wednesday, we have our normal CPI data. So I'd be watching this. Again, this is a major thing to look at with regard to what the Fed's going to do with interest rates. We want to see inflation either stable or coming down, right? That's going to signal more of a reason for rate cuts, which the market is anticipating. In fact, I think last I read, the market's pricing in about a 75% chance of a rate cut from the Fed in September. So we'll see what happens. September, they're going to release a new outlook. But they're basing it on basically two things: inflation and the labor market. So if inflation is coming down and the labor market is either stable or worsening, then they will be led to cut rates. They have a dual mandate. Maybe I could make a separate video about this, talking about the dual mandate of the Fed. Basically, they have to balance inflation versus the labor market, and those things kind of are two sides of the seesaw. So, if inflation is going up, then they need to hike rates to tame inflation. But if they hike rates too much, then the labor market will, get worse. And so then they have to cut rates to prevent a recession. And so you get this kind of dual mandate, which is like two sides of the seesaw. What we want to see here in our data is lower inflation or stable inflation if it's unchanged. Forecast is 3%. So if it's 3% or less, that would be very good. I'd be looking for that on Wednesday. Thursday, we have some retail sales. So the unemployment claims, retail sales, this all has to do with the labor market. So, our last week was 233K. We're expecting 235K. We'll see what happens there. Again, bad news could be good news there, right? If unemployment claims go up, that could mean, hey, Fed, we got to cut, right? Bullish for the market. Okay, so now let's get into the technicals. So I wanted to look at the cash index. Now we usually look at the ES, S&P, and NQ NASDAQ futures contracts. That's what we trade. But for more solid levels, I also wanted to bring us into the cash index. So cash is king. Cash index, SPX, S&P, and NASDAQ would be the cash index of what we trade on the futures. So for technical levels, I would be watching the 5,400 here on the SPX because we had our drop. We've rebounded last week. If you watched last week or if you read last week's newsletter, you would be anticipating that. We could come up into this 5,400 level, which would be, this shelf here. And that could be interesting to look at for a target, an upside target, and then to see from that point if we come back above or if we tank back lower. Now, for our long-term investors out there, I would be willing to bet that we come back above. And the reason why is because of what I pointed to you before with the VIX. We're watching this 20 level. I would, make an alert. Maybe we'll make an alert to see if we get below 20. Well below 20, 19.06. Because the fear is coming out of the markets, okay? So I'd be watching this, fear coming out of the markets, meaning markets shrugging things off, and we should head back above these 5,400 levels. Again, because the VIX spiked and reverted so quickly, I don't see us, and this is just my personal opinion, market could do what market wants to do. I don't see us coming here to rebound and then dropping off a cliff from here. Because again, to drop off the cliff again and come back down here into the 5,100s, 5,000s for the SPX, we would have to have some type of catalyst that is as much or worse as we had last Monday when we saw, again, the VIX spike. So ask yourself, what's more likely to happen? Are we going to get something else that's going to cause this fear to ramp back up in the markets? Or, was it sort of a temporary thing, a flash crash, if you will, not even a crash, pulled back less than 10%. But in my mind, this is a gift. I've said this before, from the markets to buy for long term. Okay, let's again look at the NDX. This is the NASDAQ. So if you're trading NQ futures, or pay attention to the NDX, kind of the same thing. You'll be watching for this level to pull back into sort of the 18,800s, 19,000s. For the NDX, of course, correlates a bit on, say, the NQ futures. Similar kind of thing. This level here would be, yeah, around 19,000 on the NQs. So I'd be watching for those levels. I think I would say coming into this week, I am neutral to bullish as far as day trading is concerned. And I'd be looking at those high time frame levels, but I'm not expecting many harsh sell-offs. So I think that's all I had going into this upcoming week. And again, make sure you guys like, comment on the video, subscribe to the YouTube channel, and if you haven't already, click on the link in the description to subscribe to the free weekly newsletter to make sure that you get it sent to your email inbox. All of this is free. I'm not selling you anything, so yeah, go ahead and do all those things, and I will see you guys next week.